Hello and welcome to the weekly roundup for the week ending Friday the 5th of March. Hope that you enjoy these weekly reports. Please do subscribe to receive regular stock market content. Any questions? Love to hear from you really. And also invite you to follow our free stock market reports on tech, stock, banking, stocks and IPOs. Either use the link in the description below or head to the website Research Centre. Right, so this week, a week of two halves really. At the start of the week, vaccine developments and reopening optimism sent stock markets higher across the globe. The Johnson & Johnson single jab COVID vaccine was approved. The drug maker also announced a deal with Merck, which would mean a significant ramp up in production. As a result, the Biden administration announced that all American adults would be offered a COVID vaccine by the end of May, 2 months earlier than initially expected. And this means the world's largest economy would then be reopening sooner than forecast, boosting the risk sentiment in the markets. This was then tempered dramatically with the surging bond yields over in the US, pulling the stocks lower towards the end of the week. Rising inflation expectations have sent the bond yields sharply higher, boosting the US dollar and dragging on the stocks. Federal Reserve Chair Jerome Powell on Thursday dismissed concerns over the rising yields, sending the 10-year yield to 1.5% and triggering further drops in the stocks. Here in the UK, the Chancellor's big spending budget has also offered support, allowing the UK index to show strength. The Chancellor's extension of the furlough scheme, extension of support to the high street and help to home buyers has all lifted the FTSE. So FTSE's up a couple of percent over the week. DAX is up 1.3%. Over in the US, different tale. S&P 500 down 1%, and the Nasdaq really the standout underperformer, shedding 3.5% through the course of the week. In the FX markets, the US dollar's had a strong week, rising to a 3-month high. More really overnight, following those comments from Jerome Powell. The strong US dollars pulled the euro under 1.20 for the first time since November last year. And the pound also trades lower on the week, down 0.3% across the week, and just in sub 1.39 territory, more so on the US dollar strength really, although the pound has managed to maintain its strength against the euro post-budget. In the commodity markets, we've seen oil surging over 4% on Thursday and up a further 2% today, on track for gains of over 6% across the week after OPEC Plus defied expectations and agreed to hike output from April. So this sent the West Texas Intermediary as high as $65.35 a barrel, a level really not seen since pre-pandemic times. Gold, gold has been tanking really, 2% down across the week, adding to 6% declines last month, now trading under $1,700. Vaccines, reopening optimism, surging bond yields and a stronger US dollar are making the non-yielding safe haven of gold look very unattractive at the moment. So the yellow metal is now down 18% from its August high, putting it right on the brink of that entry into a bear market territory. Copper also dropped sharply in the short term this week, and that also sort of translated to seeing a few of the metal stocks on the drop, pulling some of the bearish trends back. On the stock front, house builders have been the outperformer in the UK after the Chancellor extended the stamp duty holiday and revamped the Help to Buy scheme. So we've seen Persimmon and Taylor Wimpey up over the week. Energy stocks have also been on a sharp rally on the back of the jump in the oil prices. So we're going to see BP look set to make gains of nearly 10% across the week. Looking at the US markets, as I mentioned earlier, US tech stocks have plunged. Tesla down 8% as investors question its lofty valuation amid the spike in bond yields. Zoom is also down 8% this week on the broad tech sell-off, despite reporting better than forecast earnings and an upbeat outlook, and also despite the expected return to some normalcy in 2021. The most obvious read across to this really here in the UK stock market is a drop we've seen in Scottish Mortgage Investment Trust. Their shares have come back from 1,400 to close to £10 mark. largely to do with their exposure to the US tech stock. This will also be a keen stock to keep your eyes on as a barometer over the coming weeks. And once it's found a floor and the tech stock sell-off has found its floor, I'm sure we'll see it moving back forward, certainly with the high quality investment trust. That's all from me. Thank you very much for watching. Please remember to subscribe. Any questions, don't hesitate to ask. Have a great weekend.